Welcome to the Small Business Tax Savings Podcast, powered by Jetro. Each week, we bring extremely valuable accounting and tax tips specific to small business owners. You will be on your way to growing your business and putting more money in your pockets. Here's your host.
Hello and welcome back to another episode of the Small Business Tax Savings Podcast. We recently did a webinar on the employee retention tax credits and thought it would be great information for our podcast listeners. So that's what today's episode is going to be a recording of that webinar that we did on the employee retention tax credits. Here is that recording. What we're going to be talking about is some pretty cool tax credits that are available for business owners due to some COVID relief that was passed by the government. So we have David Mayer from Think LLP. He's a partner over there. And basically, he's going to be coming on to talk to everybody about employee retention credit and kind of what that means for your business and what the potential benefit is to you and to business owners. So David's going to be taking it from here. We also have Tony from the Jetro team on as well. If you have any questions along the way, put them in the chat and we will be answering questions live at the end. So David, welcome, and I will let you take it from here.
Thank you, Mike. Thank you, Tony. So getting into the employee retention credit, it was part of the CARES Act and really meant to incentivize companies to retain employees, simply put, during the pandemic. Similar, think of it like a PPP loan, but not administered by the Small Business Administration and your local bank, rather administered by the Internal Revenue Service. And specifically, what the employee retention credits are is they're refundable credits against your federal payroll taxes. Anytime you hear the word refundable with respect to any federal tax credit, it simply means the IRS will write your company a check from any respective quarter. In this case, as you know, you file your 941s every quarter. We'd go back and amend your 941s in your qualifying quarters to claim these credits. The IRS will write your company a check for the amount of the credits. That's what refundable means. And so so we'd be going back in time. These are 941Xs, amending those returns. The IRS is a little backed up processing these amended returns. It could be 6 to 12 months before you get the money. You're going to get the money. And as we'll talk about later, none of our fees are due until after you get the money. So we'll get to that later. As I mentioned, we would be going back and amending the returns. And the IRS will be writing your company a check for the full amount of the credits. As we'll get into, these credits can be very significant. And you can get these credits in addition to the PPP loans, the forgivable PPP loans that you've probably already gotten, PPP round 1, and then maybe if you qualified for the PPP round 2 as well. You can still claim the employee retention credits for your company. They changed those rules right at the end of the year on December 27th with the second coronavirus relief bill that was signed into law right at the end of the year. And it applies retroactively to the effective date of the CARES Act, which is March 13th of last year. So this program, it goes from March 13th of last year, currently all through this year. Just so you know, as part of the infrastructure bill, which we'll see what happens if that ultimately gets signed. But the Senate is thinking about removing Q4 from this program in the infrastructure bill. So if that does pass, it may not only be available through Q3 of this year, but we'll see what happens there. Now, so what does it take to qualify for the employee retention credit? And as I mentioned, you can claim the credit even if you got PPP round 1 and or PPP round 2. There's 2 different tests, and it's an either or test. And if the company meets either of these tests in any of the time period that I just mentioned, March 13th of 2020, currently all through this year, then it qualifies in that time period. And we'll get into the calculations and how much the credits can mean to you after. Again, 2 tests. And if either or. The first test is the gross receipts reduction test. In 2020, and then things change up a little bit in 2021. Now in 2020, the company needs to start with a quarter where its gross receipts compared to the same quarter in 2019 went down more than 50%. It needs to start with that to qualify in the 2020 year. Once that happens, so say that happened in Q2, a lot of things were shut down in the second quarter of last year. Say you had that big drop in gross receipts in Q2, then you would, to summarize the convoluted rules, you'd automatically qualify in Q3 as well as Q2. And you'd qualify in Q4 if in Q3 you had a greater than 20% drop in gross receipts compared to Q3 of 2019. Convoluted rules kind of summarized for you. That's the gross receipts reduction test for 2020. Now, in 2021, it changes up a little bit. In any quarter in 2021, you would need a greater than 20% drop in gross receipts compared to the same quarter in 2019. Always comparing things against the last quote unquote healthy year, 2019. And they also allow the company to look back a quarter to apply the rules. For example, if your company had a greater than 20% drop in Q4 of last year compared to Q4 of 2019, you qualify in Q1 of this year because you can look back a quarter and you can apply these rules. That's a summary of the gross receipts reduction test. It's a quarter by quarter analysis. In any time period where the company doesn't meet the gross receipts reduction test to qualify for that quarter, there's another test. So even if they don't meet this test, you can still qualify if you meet the second test. And that's where we can establish that the company has a full or even partial suspension of its operations above what the IRS would consider nominal, and I'll define that in a second, due to any government order related to COVID-19. And we'll get into some examples in a few minutes. This has to do with commerce, which is very broadly defined, group meetings, or travel. Now, the IRS considers nominal, so it would need to be at least a 10% effect on your company's operations during that time period. And think of that in terms of your people and their time and what they're not able to do because of a government order or mandate against city, state, local, county, federal mandate or order related to COVID during that time period. Again, we'll get into a few examples in a few minutes. Or at least a 10% effect on your gross receipts. So even if your gross receipts go up, if you had at least a 10% effect on your people and their time and what they would normally be able to do in 2019, for example, the last healthy year, but not in this time period, because of these orders or mandates, you still qualify for that time period as well to the gross receipts reduction test towards this program. So a few examples of this partial suspension of your operations due to a government order related to COVID-19 are, so for example, construction, any firm related to construction, architects, engineers, mechanical, electrical contractors, all where, just for example, the sites where some of their projects are occurring have been shut down due to government orders. So they can't go to the site to do what they would normally do. That in and of itself, even if their gross receipts goes up, they're still going to qualify for that entire time period. That's an example. Law firms. We work with a lot of law firms that do some litigation. They're in the courts a lot. And the courts were shut down. So even if, their gross receipts go up, as long as we can establish that at least 10% of their attorneys and their people and their time and what they would be normally doing in the courts, for example, but they can't do, or everything got slowed down over that nominal, amount, then that entire time period, because the courts were shut down and a lot of what they do occurs in the short. I understand that some of these things could occur on Zoom calls, and they made up some of that time perhaps on things like mediums like that. However, we've worked with a lot of law firms where we're able to, pretty significant chunk of time, qualify them because of the shutdown of the courts and its effect on their operations, their normal operations. So even if they, again, didn't meet the gross receipts reduction test, perhaps in that time period, they would still qualify in that time period because of that. Done a lot of these studies for dental practices, medical, all of these type of companies. And, obviously, even they're essential businesses, but still they had to adhere to social distancing mandates. So the room capacity, space limitations of after they weren't perhaps able to see as many patients. And again, just think it only has to be a 10% effect. Only at least 10% of they wouldn't be able to see at least 10% of their patients where they would have been able to. And again, think of like back in 2019 at the last healthy year. We look at those metrics and we establish, okay, well, they qualify for this test because of that. Doing a lot of those type of as well. Manufacturing, so disruptions in supply chain all over. You're seeing on the news all the time. With the chips and no automobiles, no one can make anything, and there's lots of all industries have a lot of them dealt with a lot of manufacturers, companies that make things or process things, where there's some disruption because of some government order related to COVID, and their inability to get some supplies that they need to make what they make and do what they do, and it affected them more than nominally, and that happens. That's happened a lot with manufacturers. Even companies that have pivoted over to making PPE and and actually had a great year. Their gross receipts went up. They had the best year. I hate to say it, but they had the best year ever because they're making, masks and all this stuff. But their traditional operations were affected. They qualified too. They would qualify for that whole time period too, as long as it's above a nominal effect, which you can see we've been able to establish that a lot. So some of the examples, real estate management, obviously we all know about the conviction moratoriums and things like that. Well, that obviously affects their gross receipts. It affects their operations, and that can certainly qualify as a partial suspension due to at least a 10% effect on their gross receipts in that time period. Nonprofits qualify for this as well. So you don't have to be a profitable company. We're working with lots of nonprofits. They don't pay income taxes, but they pay payroll taxes. And this is a refundable credit against federal payroll taxes. So nonprofits can count too. And lots of examples of shutdowns, social distancing, where they're not able to do what they would normally do. And again, just need to establish a 10% effect on their operations where they would qualify for that entire time period. Now let's talk about what the credits can mean. How significant can these credits be? So for the time period that we established that the company qualifies, in 2020, and then you'll see it actually goes up a lot in 2021. In 2020, we would be taking, to calculate the credits, we would be taking 50% in the time period they qualifies for of each employee's wages during that time period, above and beyond what was paid for with the wages that were paid for with the forgiven PPP loan. There is no double dipping. We'd have to carve out those wages. The wages that are left in that time period, we'd be taking 50% paid for health insurance premiums count too, just so you know. And we were taking 50% of those things. Capped at $5,000 per employee for the year. So if you have 10 employees, that's a potential of $50,000 for 2020. Now in 2021, it goes up a lot. That $5,000 cap per employee for all of 2020 becomes a $7,000 cap per employee per qualifying quarter in 2021. It goes up a lot. So for Q1 alone, we'd be taking 70% instead of 50% of each employee's wages, above and beyond any PPP interplay or wages that were paid for with PPP round 2, if there are any. And it would be capped at $7,000 per employee for the quarter. So if you have 10 employees, that could be $70,000 for the quarter. If you have 20 employees, it could be $140,000 for Q1, another $140,000 for Q2, another $140,000 for Q3. And because of the Senate, there may not be any Q4. We'll see what happens with the infrastructure bill, but that's what we're talking about. Now, as I mentioned, we're going back in time. We would be amending the 941s, 941Xs, checking a box, asking the IRS to write your company a check for these credit amounts. And you're going to get them in 6 to 12 months from what we're seeing. And so it's kind of a summary here. We're already at the next step. I wanted to make this simple, but the next step is a free assessment. How we work, working a lot with Tony and Mike and some of their clients, and just start with a free. Well, we start with a free assessment. We do these 15% contingent. Nothing is due until you get the checks from the IRS. Again, down the road, it's write us a check for 15%. That includes establishing the time period, calculating the credits, amending the 941s, and it includes audit defense. Audits down the road, if the IRS happens to send you a notice, which they could, and say, yeah, you amended these 941s 2 years ago, answer these questions. That answering those questions, that is part of our fees and services. So it's just we're excited to be able to do this and bring this opportunity to everybody. Now's a good time to get started. We have lots of resources to devote to everyone on this call, and whoever wants to get going with the free assessment, we can get them started right away. And so obviously working with Mike and Tony to make that happen. But I thought maybe it would be a good idea now to open up the floor to questions, and I think we have some.
Yeah, David, that was great. And just so everybody knows, we have a website set up for this. You can go to taxsavingspodcast.com/ERC. On there, there's going to have some of the information that David talked about today, as well as a form that you can fill out if you want to set up that initial call. Just fill out a little bit of information for us, and then you'll be able to set up a call with David to get that set up. So that's taxsavingspodcast.com/ERC. And so, David, a few questions come through, and I'll kind of present those for you. The first one we got was, how do we perform the test if they incorporated their business in Q1 of 2020?
Yeah, so since they weren't around in 2019, we wouldn't be able to for the gross receipts reduction test.
Yep.
In 2020, we wouldn't be able to. There's nothing to compare it to, right? So in 2020, we'd only be able to do the partial suspension of your operations test in 2020. In 2021, we'd be able to compare it against 2020 since they weren't around in 2019 for the gross receipts reduction test.
Okay, awesome.
The same quarter. Great.
Another question is, what is the deadline date to amend Form 941 for 2020? So the 2020 941s, what's the deadline date for that amendment?
So 941s remain open. The statute of limitations for 941s, just like an income tax return, they remain open for 3 years. 3 years. So if it was filed, just to add 3 years to whenever it was filed, the month after by the end of the month following the quarter. Add 3 years, that's how long you have to amend it. So we have time, obviously.
Okay. We have another question here. Can owners' gross wages be applied to the credits as well?
Unfortunately not.
Okay. And that would be for S Corp, C Corp, any type of owner. Is there a certain percentage owner that they would have
at least greater than 50%.
Okay. So less than 50% owner, their wages could be included in this.
Technically 50 or less, yeah.
Okay. We have a question here. What documentation or proof will be needed to apply for a qualifying partial suspension?
Well, so this is a subjective test. So it's when you're dealing with the IRS, the word reasonable comes into play a lot. And it needs to be a reasonable, so we'd be writing a narrative, and we'd be looking at metrics. So we'd be looking at, that, as I mentioned, the 10% effect on your people and their time. But how do you prove that? I think a better word is, how do you establish that? It's not a court of law. It's when you're talking, if this get looked at by the IRS, it's reasonableness that we need to have. You have to convince that the IRS agent that this is reasonable and move on to something else. That's what you need to do. Now, if that's proof, that's proof. But I think it's really establishing that it's a reasonable reality that you had at least a 10% effect on your operations with respect to their time and their people and what they were not able to do. And there's lots of different metrics comparing 2019 and the same people and what they couldn't do, or the patients they couldn't see because of things like social distancing, or the court proceedings, or the different things that occur in a courtroom that you can't do on a Zoom call, that backed up your all of your proceedings over a nominal effect, and then you're fine. And so it's more of it's subjective, and but it's a case by case. But hopefully that helps.
Yeah, no, that's super helpful. And I mean, correct me if I'm wrong, but as part of this initial assessment, kind of working with David to see if you qualify, they're going to, you guys will work with the client to kind of discuss, hey, what is if we're not meeting the gross receipts test, and we're kind of depending on this partially suspension test, your team will work with the client to say, yeah, based on, the data that we have, I think you would qualify for that. And obviously that's where the audit support comes in as help to, knowing that that's available there. But is that something that you would work with the client to say, yeah, we think you would qualify, or your case probably does not qualify for that test?
Yeah, we've had the advantage of working with lots of law firms, lots of manufacturers, lots of dental practices. We think just about every industry, and in different parts of the country. So we have a good sense now here what were the mandates that can apply to this for this specific industry, and so we would have that framework to start from. Mm-hmm. But it is case by case. It is a subjective analysis. But absolutely. And as long as we are comfortable that they meet the test, and we're comfortable that we can support it. If anything got looked at down the road, that's the time period that we're going to go with.
Okay. And here's probably a more specific case example, but I think that this will help illustrate kind of how you would evaluate something like that. So we have a question that says, you touched on supply chain issues, and they said, how do you calculate how that impacted our business? She said, basically, our main electronics distributor closed or had no stock available, and they were forced to get product from Amazon at full cost. This to me sounds like it probably would be part of that partially suspension, but I'll let you kind of speak on that. How would you kind of calculate how that impacted our business? And with that scenario, is that something you think would qualify?
Well, I would in that scenario, I'd focus on the greater than 10% effect on. I guess it wouldn't necessarily be an effect on gross receipts, but you're paying more than you would typically be paying. Mm-hmm. But to be clear, it needs to be a 10% effect on gross receipts, not net. And they're pretty, so that would be something we'd look into. But, and also to be clear, if it's the best scenario is when these are supplies you couldn't get, or you were delayed in getting, and that affected your operations. So if you got them right away from Amazon, Amazon is an amazing company in a lot of ways, I guess. But if you were able to get them right away from Amazon and it affected your net and not gross, that's something I'm going to have to think about.
Yeah. Okay. Here's kind of a question that goes back on those owner wages, but would relatives of the majority owner be allowed, or are they included in that unallowed?
Yeah, they're unallowed too. They're
Okay.
unallowed too.
Got it. A question that we had here that came in is kind of related to this partially suspended, and let's use a church as an example. Let's say for Q2 and Q3 of 2020, a church's doors were closed, and so obviously they could not host anybody in service. Would they then qualify? What quarters would they qualify for this credit? Again, in this example, I'm saying Q2 and Q3 of 2020. What quarters would they qualify for this credit if their church was able to open up the doors in Q4 of 2020?
Well, they qualify in Q2 and Q3. I mean, if their doors were closed because of a government order or mandate related to COVID, then they would certainly qualify in that entire time period.
Okay. So it would just be that period, though, that the mandate closed, unless they obviously met some type of gross receipts. But in this kind of example, I'm looking at partially suspended, only be for that period that the government mandate had them close their doors. Yeah,
but then in Q4, I would ask the question, okay, well, with the social distancing mandates that were still in effect in Q4, I would suspect, we'd have to verify that, and into 2021, with the social distancing mandates, that really affect the amount of people you could have in your church. And if we can establish that, perhaps because less people were there and they were less able to get less tidings and things like that, then we could probably look to that.
That makes sense to me too, because again, if you look at that 10% number, if you're used to having 100 people on a weekend and now you're down to 50, even when the doors are open, that's a pretty significant drop. Another question as we have here is, do you have to amend your tax return if you've already filed for the 2020 tax year? And I think, and then he had in more, even if you don't receive refund until 2021 or 2022. So I think what he's referring to here is not necessarily the amended Form 941s, but the actual tax return of the business.
Unfortunately, the correct answer, according to the IRS, currently is yes. I do know some CPAs that are not doing it that way because it's kind of ridiculous, that are waiting till they get the money, at least waiting to get the money and then perhaps amending that. So the correct answer per the IRS as of now is the company's wages on their income tax return, wage expense should be reduced by the ERC, Employee Retention Credit amount, in the year in which the credits are generated.
Okay, makes sense. So basically, if you get a rough numbers, a $10,000 credit for tax year 2020, the correct way to do it would be to amend your 2020 tax return to reduce your payroll expenses by that $10,000 credit that you received.
Yeah, you can just wait till you get all the checks from the IRS, and then you can always just amend it then.
Okay. One question on that is, I know we have to amend the return, then wait for a check in the mail. Is there any possibility that we can, instead of wait for a check in the mail, apply that credit against future 941 filings?
Yeah, you do have that opportunity to do that, yes.
Okay. That looks like the majority of the questions that I'm seeing, Tony. Is there anything on your end? Someone asked, can we get a recording of this session? Yes, there will be a recording of this. And again, if you're looking to set up a free assessment, talk with David and his team to say, hey, do I qualify? Here's my situation. You can schedule a call. Again, that initial assessment will be free. If you go to taxsavingspodcast.com/ERC. There's going to be a form on there, answer a few questions, and then that will get forwarded on to David, who will then give you a call, set up a time to discuss and see if this qualifies for you. But Tony or David, that looks like all the questions that we have in here. Any last items that you kind of want to discuss before we let go for today?
Hey, Dave. So can you kind of go over the process that Think has with this ERC process and the timeline and the fees and all that stuff as well?
Sure. So, what we'll do is everybody that's interested, we'll set up an initial assessment call. And I'll kind of go over, okay, just based on what you're saying, high level, here's what I think, here's why I think you're likely going to qualify. Here's what the credits could mean for you. Then, I'll get you an engagement letter, that 15% contingent as discussed. Get a project manager, one of our project managers assigned to your study, set a kickoff call. What I send out right away is the information request list. To the company right away with a secure link where you can start providing information to us even before the kickoff call. Things like gross receipts, things like some basic information. Just all thinking about the time period you're going to qualify, and have the kickoff call. Should depending on the size of the year, usually the credits should get calculated in 2 to 3 weeks. Then we'd be amending the 941s, right, in the prior quarter. We take care of that. We would amend these are 941Xs. For Q3, we still may have an opportunity, with your payroll processor to get them on the timely filed 941. We'll see. We'll see if we can do that. We will. If not, we'll amend it. And then you'll get them into the IRS. You'll sign them. We'll get them into the IRS. Then again, it's a waiting game. You probably receive these checks to the company, right? Even if it's a flow through to the company, there's a payroll. Always paid by the company. It's checks to the company in 6 to 12 months for the amount of the credits. And our fees, again, are 15% contingent. Nothing's due until you get the money. And that includes any audit, any audit defense support, you need down the road to answer any questions. Yeah, if you happen to get a notice from the IRS down the road about these employee retention credits.
Absolutely. And then another thing was, this was a question another company had, and they were going to close down. It was a restaurant chain. They had a few locations that they're going to shut down because of poor performance, and they wanted to shut it down next year. Now, the key is you want to keep those bank accounts open so that you can deposit those checks. So when you receive them 6 months down the road or 12 months down the road, make sure you keep those bank accounts open, even if you dissolve the company at that point.
Yeah, it's exactly right. Yep. The IRS will write the check to the company, obviously. That's fine. Nothing wrong with that.
Yeah, it's a great process flow. Everybody it would benefit from this free assessment. There's no fees up front, as David mentioned, and the payment won't be made out until you receive those checks. So, Mike, do you have anything else to add?
No, I think that's good. I think one thing to remember here is that if you are the only employees that you have are the owners or relatives of the owners, this would not be a qualification for you. This would not work in your scenario. But for anybody else that has non-owner employees or non-relative owners of the employees, this could be a great opportunity. And I think at least jumping on a free assessment to see if you qualify and how you'd qualify would be good. So David, I appreciate you jumping on. This has been super helpful. And again, I think that this is just an opportunity that is available to so many small businesses out there. And it's really good that what you guys are doing to bring awareness to this, because I think it was kind of like the PPP at first. There was a lot of confusion, unknown things. This one, I think, is even more complicated than the PPP when it comes to the calculation, amending returns, determining this partially suspended. There's a lot of moving factors in this. And that's why I think it's so good that you are working with these companies to help this out for a 15% fee to cover kind of the time and work you guys are putting in. So thanks for jumping on, David. I appreciate it. And
my pleasure.
This has been another episode of the Small Business Tax Savings Podcast from the team at Jetro. If you enjoy our weekly episodes, please leave a review on whatever platform you listen to us on and share with other business owners. If you have any questions or future topics you want to hear, email them to tax@jetrotax.com. Thanks for listening and have a great day.